Hey, I'm Michael and I'm the content lead at Simply Wall Street. In this video, we're going to have a look at the bullish and bearish narratives around Coca-Cola, and we'll show you how those narratives translate into different valuations for the company. Now, more importantly, later on, we'll show you how you can create your own narrative based on what you think is probable, and then how you can translate those sort of qualitative thoughts into a quantitative valuation. Because as you know, at Simply Wall Street, we want to help you think long-term, reach your own conclusions, and be a lifelong learner. So yeah, in this video, we're going to concentrate on the bullish and bearish narratives. If you would like to see more context on this, we actually have an article, and I'll provide the link below, that goes into more depth on the whole business itself and the strengths and weaknesses that it has. Additionally, we'll provide a link to the Simply Wall Street company report, where you can have a look at the whole company report for Coca-Cola and see where a lot of the data we're talking about is being pulled from. So anyway, let's dive into the narratives. We'll start by looking at the current share price and seeing what it reflects in terms of the market's expectations for the company's future. The current share price of $62 implies that the market is expecting earnings per share growth of around 13.5% for the next few years. To put it another way, if we were to say earnings per share will grow at 13.5% for the next few years before declining, and we discount those future earnings at around 8% per year, the fair value estimate for the company would be around $62. Now, you can see on the left-hand side here that you can change those assumptions to be higher or lower depending on what you think is possible, and we'll get to that later on. To give that growth rate some context, let's have a look at the historical growth rates and see what's actually occurred. Over the last 5 years, earnings have increased by 21% per year. However, before you get impressed by that figure, the number is somewhat misleading because the company had a large one-off tax bill in 2017, which means it started from a very low base for that 5-year period. If we were to look at the 4 and 6 year historical periods, we can actually see that annual earnings growth has been in the 6 to 10% range, so that 13.5% is quite a high expectation compared to its historical growth rates. Now let's dive into the bullish narratives. So as we just saw, the current share price actually implies quite a high earnings growth rate of like 13.5%, because that's pretty decent. But there's some analysts out there who think it can grow earnings per share even quicker. At the top of the range, some analysts are expecting earnings per share growth as high as 19% for 2023, followed by growth in the low teens. Now, if we're expecting this higher rate of earnings growth to be possible, there's a few key catalysts we would need to believe are likely to occur in order to justify or back up that higher earnings growth rate. So we're going to talk through some of the key catalysts here. The first key bullish catalyst would be that the business strategy and restructuring that has occurred over the last decade will continue to pay off. Coca-Cola has divested many of its low-margin bottling plants, and this has helped improve the company's margins. So in this case, margins should therefore stay at the upper end of its recent range, which is in the mid-20% range, which is decent profit margins, to be honest. Additionally, part of this business strategy is that Coca-Cola has been increasing its prices in markets that can absorb these price increases. So this means that if this strategy was to continue, revenue could potentially keep increasing even if the volume of drinks that it delivers remain flat just due to higher prices. The second bullish catalyst would be that sales growth from its new product segments will increase. As we've outlined in the article, Coca-Cola has entered several new product segments, including the likes of juices, iced teas, hot beverages, other bottled water, and other types of drinks. Current contribution to the revenue from these segments is relatively small, but they represent a large opportunity for the business. So the bullish perspective here on this catalyst is that growth from these new segments could potentially offset the decline in sales in the carbonated drinks market that it has. The third bullish catalyst would relate to positive sales growth in emerging markets. Most of the recent revenue growth that the company has seen has come from the North American market, with all the other markets lagging behind. One of the reasons for this is that Coca-Cola has been raising prices in North America, but in these other markets, it's been focusing on its brand and distribution networks. As this strategy begins to pay off, you'd imagine that growth from outside the North American markets, which represent 55% of sales, will accelerate. Now, if you believe that all these catalysts just mentioned, and maybe some more, are likely to occur, then the 19% annual earnings growth rate estimate from analysts might make sense to you, and therefore the $77 price target from analysts could also seem fair. If that's the case for you, then you might think that the company has 24% upside from today's prices, given the current difference in valuations. However, not all analysts think that these catalysts are probable, and there's some others that they actually think will drive the company's future, and not in such a positive way. So there are several reasons why the bearish analysts aren't as optimistic about its growth prospects, and we'll list some of these below. So the first bearish catalyst would be that most of Coke's business is exposed to a very mature market. Approximately 70% of revenues come from the carbonated soft drinks market. Now, these carbonated soft drink sales are declining as the world moves away from sugar and towards healthier drinks. Also, Coke's market share is already quite high, so rather than being a small player in a growing market, it's a mature business in a mature and somewhat declining market. So if you follow the natural trend of business cycles, it's unlikely that long-term revenue growth is going to occur from its core business. The second negative catalyst would relate to the limited advantage that it has in its new product segments. As we outlined in the article, Coca-Cola is actively diversifying into new product categories such as juices and hot drinks and stuff like that, but the penetration in these new segments has been quite low. Coke doesn't have the same advantages it had with the classic brands in these new segments. Additionally, its ability to make acquisitions in these new segments could be blocked by regulators as it continues to increase its market share through acquisitions. So consequently, as a result of this, its opportunities for new sources of revenue might be limited, and they may actually not offset the loss of growth in sales from its carbonated soft drinks. The third bearish catalyst facing the company just relates to a number of risks that they're currently facing. The first is the ongoing dispute it currently has with the IRS, and this dispute could result in a tax bill as high as $14 billion. The company has currently got a provision of it for just $400 million, meaning that if they're wrong and it's higher, there could be a very large one-off charge to its earnings. Another risk is that over 50% of its revenue comes from outside of the US, and therefore it is exposed to currency risks. So for example, if the USD remains strong or even appreciates further, revenue growth will be capped from these external markets because the revenue from non-US sources will be weaker when you convert it back into the USD. Another risk is the current high debt level of the company. Basically, it currently has a debt to equity ratio of 160%, which means there is considerable interest rate risk if it goes to refinance some of this debt. However, we had a look at the annual report and you can see that about 60% of the debt is maturing after 2027, so the impact is relatively low for now. Another risk is that the dividend payout ratio is quite high at around 80% of earnings, and it may become unsustainable. So cutting the dividend could signal, if they need to, could signal a lack of confidence and cause the dividend investors to abandon the stock. However, if they try and maintain the dividend, it could result in a higher debt load and higher interest expense if they need to take on debt to pay out the dividend. So those are some of the bearish catalysts facing the company and some of the prominent risks that it's having to deal with. If you think that these are more likely than the bullish catalysts we just mentioned before, then you'd probably be a bit less optimistic on the company. If you think that these are more likely to occur, then you may believe that the earnings growth rate estimate of 12% makes more sense, and the associated price target of around $58 could seem fair to you. If that's the case and that's what you think is likely, then you may believe the company is a little bit overvalued at today's prices. So that's the bullish and bearish narratives around the company, and as we said at the start, we're now going to provide some questions that you can ask yourself to help you build your own narrative around the company, and then we'll show you how you can translate that into a valuation. So here's a few key questions you can ask yourself. The first one is, do I think the localized pricing strategy will allow them to continue increasing prices steadily in mature markets and growing emerging markets? If so, how do I think this will impact revenue growth? The second question would be, do I think the company will be able to generate revenue growth in its new segments to make up for the decline in the carbonated soft drinks consumption? And if I do think that's possible, how will that contribute to future revenue growth? The next question would be, do I think emerging markets will provide revenue growth that the mature markets can't? And if so, how much will they contribute? The next question would be, do I believe the dispute with the IRS will result in a huge tax bill? And if so, how much could it be? And that's anywhere between $400 million and potentially $14 billion. So to get a better idea on that one, you might need to look into the current position of the legal dispute. The next question would be, do I believe the company's current debt load is manageable? And if so, will its profit margins be impacted severely by higher interest rates if it is refinancing its existing loans? Now, to help you answer these questions, like I said, we've got that article which goes into a lot more detail on the company, but you can also do some digging and basically try and find what the potential outcomes are of these different segments. The article should help, but again, you can do some further research to find your own answers. Now, once you've got your kind of perspective and you've written down what you think will happen for each of these sort of catalysts, you can then go into the Simply Wall Street Stock Valuator tool, which is currently in beta, and you can basically play around with the different inputs to see what valuations might make sense to you. So based on what we mentioned for the bearish and the bullish analysts, you might want to change the growth rates accordingly because you may have a different perspective, right? So you may believe an earnings growth rate of 19% is possible, but you may want a higher discount rate because of the way interest rates currently are increasing. Alternatively, you may think, nah, the company's not going to grow that much, and even the 12% per year might be too high for you, so you may go for a lower growth rate, and you can just see here how that changes the valuation accordingly. So that pretty much wraps things up, but just to summarize, have a look at those bullish and bearish narratives again, and have a read of the article because there's a lot more detail in there, and basically just ask yourself those questions that we just posed so that you can then kind of start to formulate your own narrative and then turn that into a valuation. Again, as always, it's important to think in a broad spectrum of possibilities rather than just a binary good or bad, so try and think of all the different outcomes that are in the middle. We've just outlined like the highest and lowest price targets, but there could be plenty of outcomes that are possible within there or even outside of those boundaries. So it's important to kind of come to those conclusions yourself. So some useful next steps would be 1, add Coca-Cola to your Simply Wall Street watch list, and number 2, start taking down your notes in the Simply Wall Street platform on the new notes feature we've added, where basically you can keep it all in the one place, so you've got your portfolio and all your notes all in the one spot. And just a final reminder, think long term, reach your own conclusions, and be a lifelong learner. Thank you so much for watching, and we'll see you next time.